Welcome back to my mentorship series, everybody. I know it's been, a few days since my last video, but I hope you guys have had time to catch up on episode 1, 2, 3, 4, 5, and 6, right? By now, you should understand my entry model. You should understand why I trade prop firms, why I trade futures, all of that good stuff. We've begun to get a bit more technical, right? Last episode was DDE, draw, delivery, and entry. So those are the factors, the criteria I look for before getting into a trade, right? But how do we manage a trade? How do we manage risk appropriately once we're actually in? That's what we're going to be breaking down and covering in episode 7 here. So this is all about stop losses, risk management, trade management, right? And different various factors that encompass that, including sizing and scaling. So right off the bat, starting with placement, right? My stop placement, it's always chart based. I don't risk a fixed point percentage or percentage of my drawdown. Generally, it's about the same because I have a very constant entry model, right? I'm only entering 1 minute and 30-second inversions. So my risk is generally ballpark the same, right? And what does that usually look like? It can be anywhere from 10 to 15 to about 20 points in normal conditions. And we're going to cover some abnormal circumstances here in a bit. But in a normal market, with normal ATR on our NQ daily, my stop losses are generally on average about 15 points, right? With one mini, that's equivalent to about $300. Sometimes it's less, like I said, and sometimes it could be more if price is really volatile, right? If we're coming right out of the open or we just had news, it could be 20 points or so. But again, chart-based stop losses, when we are basing our risk based on, PD arrays in the market, displacement candles, highs and lows, this makes a lot more sense to me versus just entering and saying, okay, I'm only risking $100 on this trade, or I'm always going to use a 10-point stop or a 20-point stop. That doesn't fit, each setup, right? Each setup is unique. No two setups, as similar as they might be, are identical. So we need to accommodate appropriately, right, for the uniqueness and respect each setup for what it is. So chart-based stop losses is what I'm always going with. When it comes to risk management, I trade the same size on every trade, okay? On 50K accounts, I'm generally trading about a mini. I like to use one mini per $2,000 or $2,500 of drawdown. That's for funded accounts. If I'm trading a 150K with Apex, let's say, and I have $5,000 of drawdown, I'll trade two minis, okay? But generally, one mini per $2,500 or $2,000 of drawdown is safe, right? That's, about 100 points, 125 points if one trade were to lose, right? Of course, we're not risking anywhere near that in a trade, but, that would require multiple back-to-back-to-back stop losses being hit, which is very uncommon in a high win rate strategy like the one we trade. So that's my sizing, right? Now, if we do that math, one mini, if I'm generally risking about 15 points, that's about a $300 risk on average per trade. And I'm generally targeting, something similar. Some of my trades might win for 17 points. Some might win for 13. Some might win for 15. Some might win for 20. On average, I have about a 0.85, 0.9 average risk to reward, right? And a lot of people just don't understand, how can you be profitable with a risk to reward like that? Well, it's simple. There's a concept called expected value, right? Your expected value, if this is my average risk to reward of 0.85 to 0.9, for simple math, let's just say I'm risking 20 points and I'm targeting 18 and I'm getting 0.9 risk to reward. Yes, my loss, if it was a stop out, would be marginally bigger than my win if it was a winner, but we need to look over a large sample size. We need to look over the course of 10, 50, 100 trades to get our win rate, right? And over the last 2 weeks, right, so since last Monday, today's currently Tuesday, I've taken a total of 8 trades, 7 have been winners. That's an 87.5% live win rate. This isn't backtesting, this isn't hindsight. This is me live on stream every day with you guys in the Discord, taking these trades. Like I said, the last 7 trading days total, I've taken 8 trades, only 1 loss. So that's how I get away with a lower risk to reward ratio. And because my win rate is that high, I can afford for, 1 loss every here and there to be a little bit bigger than my average win. That's absolutely fine, right? So your win rate multiplied by your average realized risk to reward is how you calculate expected value per trade. Of course, you can't guarantee the outcome of any one trade, but like I said, over a large enough data set, you can calculate your expected value. So again, going back to those chart-based stop losses, I want to allow price to have enough breathing room to retrace if it needs to, but I also want to be entering after manipulation has occurred. So most of the time, my best trades usually go very quickly. And going back to that constant sizing, right? Another reason for that is you don't want to be oversizing on one trade. just because it looks better to you, right, than the last trade. Ideally, every trade should have that draw, delivery, and entry, right? Those are A+ setups. Now, of course, some trades look just phenomenal and you take it with your eyes closed. Does that mean you should size up? No, it really doesn't, because you can never guarantee the specific outcome of one trade. And if it just so happens to be a loser, which it very well could be, although the trade might have been a good loss, you did everything you should have, right, in confirming that DDE prior to entering. Because you oversized, suddenly you've wiped away, a day or 2 or 3 days of gains because you decided to size up, right? So constant sizing is really always a good idea for my scalping model. And lastly, we're going to cover stop management, and I'll get into a bunch of examples here. Stop management when you're actually in a trade. When should you be de-risking? When should you be trailing your stop? If you've watched ICT 2022 series, he suggests various trailing tools like, okay, when you're up 50% to your TP, you should move your stop 25%, or break even, and 75%, you should put it in profit. I don't get that dynamic with it. I like to be pretty structured. If X, then Y, right? So if we hit a conflicting PD array, right? So if I'm long and price taps a bearish FVG or a bearish volume imbalance that's still present in the market, I'm going to de-risk there. If there's any adverse reaction that can be caused while I'm in a trade, I want risk off the table. If I'm not getting out there, let's say it's only 5 points, right? That's not enough for me to get out. I'm going to de-risk and completely, take all potential losses off of the table. So number one, like I said, we're going over stop placement. What PD arrays do I base my stops on? Generally, displacement candle highs and lows. Right? Displacement candle highs and lows. What does that mean? It's just the candle that gives us the inversion itself. Generally, that is a safe candle to place your stop at the low or the high of. So if we get a bullish inversion, price closes above a bearish FVG, let's just say, I'm not going to draw out everything. By now, you guys understand what an inversion is. But if price were to close above a bearish FVG here, right, on this candle, this is that close. It's our signal to go long. A stop at the low of this candle, assuming it's within, your risk to reward means, is typically very safe. Price doesn't need to come back down, right? It's already come down. It's come back up. Generally, this is not going to be violated. So I like putting my stop at the low or the high of these displacement candles, respectively, if I'm long or short, right? As long as it suits my risk to reward. Now, another question I get a lot is, when do you decide to wait for a retracement, right? When am I jumping the gun and just buying this close? And when am I, waiting for a retracement? So let's use this example on the charts here first, right? We have equal highs over here. This is actually today's price action, January 13th, 2026. This is high of day, and price came up, engineered some buy-side liquidity, and left relative equal highs. If I were targeting these equal highs, let's say I had an inversion somewhere like here. Obviously, this isn't a real trade. We'll show you some real trades here in a second. For me to jump the gun and buy this close, I would only be getting about 0.54 risk to reward. This is not good. I will never take a trade with this low, risk to reward here. Instead, I would wait for a retracement, right? I'd be looking at a retracement that justifies my 0.85, my 0.9 average risk to reward. So something like this, I would take, right? Let price retrace a little bit on the next candle. We usually do see some retracements. Price will form a wick. And then, this would be my entry. And hopefully I would see delivery, something like that, right? But, if I were to jump the gun and take this, I'm fine completely staying out rather than having to get in here, right, and then be risking. Because, again, my stop needs to be in the same place regardless. You can control your entry. You don't have to be jumping in, buying the market because you have a fear of missing out on the move. Right. Instead, I would place my limit order somewhere down here, like I said, and look to satisfy that risk reward that I'm looking for, right? So that my stop can remain in the same place. Because what's the alternative to this? Well, let's say you jump the gun, you get in here at the close of the last candle, right? Not waiting for any sort of retracement. And you decide, hey, instead of putting my stop where it needs to be at the low of this displacement candle, I'm going to put my stop around here just so I can get one-to-one risk reward. Okay, that's great. That sounds good in theory, but what are you going to do if price needs to retrace, right? If price needs to retrace and comes down all the way down here, well, not only would you be in deep drawdown and have been stopped out, I would have gotten my retracement entry, right? And my stop would still be holding in the market, right? More often than not, price doesn't end up breaking this displacement candle low, and it'll instead come back up, reverse, and go to my TP. There's plenty of examples of this. You know, just yesterday I was in a trade, I was in a long, and I'll show you guys that here in a second. You know, I was in drawdown for a minute, maybe 2 minutes, but my stop held. I'm not worried. I'm not adjusting my stop. I'm not trying to loosen it because I think I'm going to get stopped out. I've back tested enough to know displacement candle highs and lows are generally very good areas to put your stop. Right, so let me actually pull up that trade from yesterday and show you that example. This was Monday. So I don't know if I have, it was a 30-second IFBG entry. I'm not sure that I have the 30-second pulled up here, but you know, we had just tapped into a fresh 5-minute FVG. So going back to delivery, right, we had our high of day draw up here. I had an entry right in here. It was a 30-second FVG. So this was my average cost was something like 652 or 852, excuse me. My stop was the low of this displacement candle that gave the inversion itself, and I exited at this upper fresh 1 minute. Let me actually pull up the 30-second so you can see my exact entry. Okay, so this was the 30-second at the time yesterday. This was the inversion, right? Price had just tapped that fresh 5 minute, so we had our delivery, we had our draw, like I said. We got that inversion. I bought on a retracement. Like I said, you can control where you get in. So to satisfy my risk reward, I'll buy on retracements whenever I need it, right? My stop was the low of this 30-second displacement candle because this is the candle that gave the inversion itself. Again, this is a very quick scalp. I ended up getting out early at this internal liquidity because we formed a swing high, right? Price came down, so I was in drawdown, but I wasn't sweating it. You know, price has just tapped a fresh 5 minute. It's reacted, it's bounced. So this displacement candle low should hold, right? And you see it reversed, right? I ended up getting out instead of up here. I got out early just to lock in those gains, right? This was about $200 on 20 accounts. That's a $4,000 trade. You know, I don't need much out of the market. Again, going back to the entire thesis behind scalping. So this was it, right? Stop here, entry here. My TP was here. Originally it was here, but I adjusted because we did form a swing high, right? So going back to trade management while I'm actively in a trade, anytime we form a PD array that price could, you know, sweep, because buy stops could accumulate here, we could sweep it reverse. I'm just going to de-risk there or get out like I did in this example. But great example there of displacement candle low being a stop. Another trade I want to touch on real quick. This is an example of me going break even. Okay, this is, you know, a situation in which I'm taking risk off the table because of another PD array that formed while I'm in the trade. So just like the last trade, I ended up getting out early at internal buy side liquidity at that swing high. I had a short here. This was last week. You see price inverse this bearish, this bullish 30-second giving a bearish inversion. I sold on a retracement, right? My original plan was to get out at this lower FVG, at this lower bullish FVG that was holding because price would probably bounce there, right? So that's where I want to TP. You know, I was shooting for about 14, 15 points on this, which is fine. My stop on this trade was actually not the candle that gave the inversion because you see it was very small, but it was this initial displacement candle, this reversal candle that sort of triggered that inversion, right? So my stop is there initially. I sell on a retracement after we get this close. Price comes down and it actually takes out a swing low. So we formed this swing low once I was in the trade. I decided, hey, I'm just going to de-risk here. You know, I could have gotten about 10 points of profit, but I wanted to potentially let it ride. Ultimately, I made the right decision, right? Price swept an internal swing low. Who knows what adverse reaction could be caused there. Okay, here is another example of our stop being at a displacement candle low. This is another live trade I took last week. What did we have here? So you see I have this candle high marked out. This was data high. Price sold off, came back up, gave a nice V-shaped recovery, right? We had a bullish trend all morning. We tapped a New York discount. So bullish trend, high of day draw, discount delivery, right? And quick up, quick down, which I love, right? I love when we form a bearish FEG quickly on manipulation, we come right back up and inverse it. That's good. Now, I didn't jump the gun on this trade. Again, going back to controlling our entries. Price formed a bullish 1 minute FVG, if you can see that here. I waited for a retracement to that FVG as my entry. Okay, why? Because my stop was the low of this displacement candle here. Okay, so that was my stop, roughly. My entry was here at this fresh 1 minute FVG, and as you can see, I was getting about 0.91 risk reward, which is great. You know, I love trades that are in that range. virtually no drawdown, maybe 5 points or so there. Stop held, price did not want to violate this low, came right back up. I didn't get out at data high. I instead got out again at internal liquidity at this swing high that formed. Great trade there, right? Instead of trying to put my stop somewhere in this FBG that formed, or not even having a stop, I have a defined systematic stop placement right there. Okay, so let's look at an example from today. Like I said, this is January 13th, Tuesday. What do we have in the morning? We already mentioned these relative equal highs that were formed. So this was high of day. Price came up, didn't penetrate it, right? So trapping a whole lot of buy stops there, letting the market trust it. So I have that serving as my bullish draw. Okay, obviously we had a huge sell-off here. I'm not trying to force any longs. We didn't get any great inversions here, right? Nothing for us to take. Going back to conflicting PD arrays, right here, if you see, we did get a 1 minute inversion, but an inversion is not a complete trade, right? An inversion is just the one small factor that's the entry model, but if there's no draw and delivery, and if there's no, or if there is a conflicting PD array, I'm not taking a trade like this. And what is the conflicting PD array here? It's a volume imbalance. So, kind of touching not necessarily on stop placement, but rather on risk management, when not to put risk on. If we tap a volume imbalance, price doesn't close above it. Well, at the end of the day, it is an imbalance. It's a reason for price to reject it. So I'm not going to take that, right? Keep in mind the natural order of a candle. We have our open, we have our close. This close is the very last nanosecond in price. So if we have a wick above this close, that means we tap this volume imbalance and then closed here. Otherwise, in my book, we rejected it. We didn't close above, we didn't inverse that volume imbalance. So this was a trade to stay out of, right? And that's the benefit of, a methodical process like this, where I have these different PD arrays outlined, right? I know what to do. I'm not taking this trade, and as you can see, I avoided a loss there. So risk management side there, setups not to take. That is an example. Now, if we look at a setup worthy of taking, I'll show you that right here. This was actually a trade I took live today, and I'll show you my P&L after it. I took a couple of trades earlier. I'm not going to break all of them down, but I initially had one short here that got stopped, which is fine. Still a great trade. We rejected a fresh 5-minute FVG. I had another short here that took profit. So I was break even on the day. I did want a good quality long though, right? We had swept Asia lows. Like I said, we had our relative highs here at high of day. And, needless to say, we were in a deep discount of our New York range, of course, right? So what did we end up getting? This was a phenomenal long here. We swept our low of day right here. Okay, so there's one delivery array, very strong delivery array too, right? Anytime we're sweeping low of day, that is a strong reason for a reversal when the context is there, when we have a draw pulling us up. And as you can see on that sweep, we formed a bearish 1 minute FVG. Okay, here's that bearish imbalance in the market, right? So a part of that manipulation sweep, and shortly after, again, beautiful V-shape inversion. These are the types of inversions I really love. Quick down, quick up. This is a great close to go long on. Now, in this case, I ended up buying a bit of a retracement. In hindsight, yes, I could have held, but, I only got about 10 points, 12 points on this. But still, it's a great trade for me. Everything is there, right? And I'm stacking up those hits. Again, when you're trading one mini and you're copy trading 20 accounts, this is, $4,000 trade. This was my trade. I had a stop actually not at the low of a displacement candle, but I'm just showing you a different variation of stop placement. Why was my stop not all the way down here? This is just way too big of a candle for me, right? This had a larger ATR than the other candles surrounding it. So I'm not willing to risk that much on this trade, of course, right? This doesn't meet my risk to reward preference. And another factor here, right? We swept low of day. Anytime we have a quick down, quick up move and we sweep liquidity, we really don't need to come back down very far. So my stop was just about CE, consequent encroachment, ICT term of this inversion itself. We'll touch on this here in a bit, but just showing you guys a retracement entry, right? This doesn't look like much, but if we closed here on this candle, right? I'm looking for a small retracement. I got in right here, and I'm exiting at internal liquidity. I got out there. My stop, about CE of this FVG. And my P&L as a result of this trade, keep in mind I was break even on the day prior to this trade. This is what the trade afforded me. Okay, Again, just stacking these base hits, you know, that's 5.2 grand when you copy trade it. So that was you know, phenomenal A+ setup. Anyway, the trade I really want to show you guys is right here. Okay, so we had already established, you know, a bit of a bullish trend. Now, at this point, I'm not chasing longs up here. We're already pretty high up. You know, market bottomed at about 809, came up over 110 points. So I'm instead looking for retracements, right? I want to be seeing retracements. I want to see bearish FVGs form when price comes down, right? And then I want to see those V-shaped recoveries and inversions of said bearish FVGs. What did we get? Well, you can see it here. We had a huge flash wick come down, right? We were still in a discount of our daily range, as you can see below equilibrium, but we had also come into a discount of this newly formed range. Okay, price had tapped this bullish 1 minute FVG, right, and one just below it as well. So we were reacting right here to, you know, discounts on multiple ranges, bullish FVGs that were created in this reversal. And what did we get? Well, fortunately, we had a bearish FVG form right here. This is an example of price already having come down. So I'm not expecting it to come all the way back down again, right? If it did, I would be wrong. The trade would be invalidated. So I don't need to risk that. Instead, you know, I'm just going to put my stop at the low of this candle that gave us confirmation that this trend is resuming, right? So let's see what the risk reward looks like. If we bought this close, we put our stop there and we can target some, you know, internal swing high, something like this. This is phenomenal. And the only reason this trade is such high risk reward for me is because we already had this massive wick here that took out plenty of sell stops. So that's what's affording us such great risk reward. So again, buying this close, you know, I don't need a retracement. It's already good enough. Stop at the low of this displacement candle, targeting this internal buy side liquidity, this swing high, right? I'm not always shooting for the biggest TP. Any swing high internal, I'll take that. So we'll buy this close. We'll set our TP. We'll set our stop, right? And then we'll just see how the trade plays out. Keep in mind, stop is at the low of the displacement candle. Boom. Right, 3 minutes, instant delivery right there. That's coming off of a huge manipulation candle. And as you can see, that stop was perfect. What did price end up doing? Well, obviously it didn't break the low, but we just reacted to this last order block, right? This candle's body is acting as an order block here. And we respected CE or mean threshold of it approximately, right? We dug into the body, but you see we didn't violate that close and price came out of it. So another great example of displacement candle stop placement. Another live trading example from last week. Here, this is a 30-second chart, right? You see we had built up some trendline liquidity in the form of lower highs here, right? Good draw pulling us up. We had come down, we had tapped, you know, not only this 30-second FVG, but some other freshly formed bullish gaps, right? And we had also left a bearish gap on that quick move down. That was inversed with a V-shaped recovery, right? I bought this close. Now, a couple options here, a couple ways to play this. If you want to be on the safer side, you can put your stop at the low of this displacement candle, like we've been discussing, right? Let's say you're targeting this first swing high, which is what I did. I actually, you know, because we came down and came up really quick, I'm not expecting price to come all the way back down here again, right, before delivering. I'm instead, you know, expecting bullish PD arrays to hold. So I'm looking at this last 30-second body as an order block because we displaced above it. And I'm putting my stop just about below mean threshold, 50% of this order block. So right about there, right? This is my entry. This is my TP. This is my stop. This was about 1.1, 1.2 risk reward. Phenomenal. Why am I doing this? Because we came down quickly, we came up quickly. I'm not expecting price to come right back down, right? When we are on side trend, we have a bullish draw, we have delivery. Price shouldn't need to come back down here. If it does, it's probably reaching for some more sell side liquidity. So great example there of order block mean threshold trades, right? And let's visualize that real quick. Okay, so if you guys aren't already pretty familiar with order blocks, what are they? Order blocks are a counter trend candle in a an overwhelming trend itself that's followed by displacement. Okay, keyword there is displacement. Not every bearish candle like this in a bullish trend is an order block, right? They're followed by displacement confirming resumption of that original trend. Okay. So the thinking here, right? Again, this is pretty rudimentary. Most of you will know this, but smart money institutions, whatever you want to call it, they're buying on retracements. They're buying on pullbacks in a strong bullish trend, right? And that's represented, visualized by these counter trend candles. So if we're expecting smart money to be accumulating here, well, they're going to defend their position when price comes back to this PD array, right? This order block. So in this case here, you see we retrace to this order block, tap it, and bounce right off of it. This is a great example of a strong reaction to an order block, right? And anytime I say mean threshold, MT, that's an ICT term, again, just referring to halfway of that order block. So sometimes, you know, if I need to accommodate for that order block being retraced to, I can put my stop at the low of it, or, you know, the mean threshold. Again, I want to see a quick reaction like this here. I don't want to see price really, you know, dig all the way through it like this. This is way too much for me, right? This order block it's doing its job, it's holding, but good, valid, strong order blocks will typically have reactions like this, where we don't even break 50% mean threshold of it. So coming back to this example here, right? Considering this as an order block, this last candle here, you know, we got displacement, we had an originally bullish trend. I don't want to see more than 50% of it retraced to, so that's why my stop was there. Final example here, bit different, right? This is not a displacement candle, well, not an inversion candle stop placement, but instead stop placement at the high of a candle that rebalanced a bearish FEG. So you see market reversed here after a high of day sweep, right? We get that inverse V-shaped reversal, but you know, price tapped this bullish FEG. So I'm waiting on a closure below this FEG to short. I get that close there, right? Short on a bit of a retracement. Where's my stop? In this case, I'm definitely not putting my stop at this swing high. This swept high of day, I don't want price to come anywhere near that. But fortunately, like I said, we formed this bearish FEG and price tapped into it right here. Okay, so if you've studied ICT again, this is known as an intermediate term high because it rebalanced this FVG. I don't want to see this violated, okay? This was the market proving that, okay, we're going to reject bearish PD arrays. We're not going to be violating this, right, until we achieve some sell side objective. So my stop was here, right? As you can see, my execution average was there, and I got out at this internal liquidity. Great risk reward, 1.2 for me. Phenomenal trade, right? The thinking here is always, you know, at what point does this trade become invalid? Where am I happy to stop out at? In this case, it was that intermediate term high, because if price came back up there, I don't want to be in it anymore, right? So various ways to place your stop, right? But they're always chart based, and they're always, you know, based on a PD array that's interacting with my current trade thesis, right? If I'm bearish, you know, I don't want to see highs being broken. If I'm bullish, I don't want to see lows being broken. I don't want to see bullish order blocks being violated, and vice versa, right? So I hope this has been helpful. Lots of different examples here, but main takeaway, right, is I'm keeping a fairly constant risk exposure. I understand my expected value based on win rate and average risk to reward. You know, most of my setups are generally about 15 points of risk, and, you know, I'm targeting a similar point amount in profit, right? And I'm always dynamic and adapting to each unique setup, right? I'm respecting the setup for what it is. If this has been helpful, guys, please leave a like, subscribe, and share it with someone you think it would also help. And join our free WAP, right? We have a, you know, in addition to our free Discord link below, we have a free WAP with tons and tons of guides. So when you join our WAP, you will see all of these guides available for absolutely free, right? You don't have to pay me a dime to learn. You just need to look at all of these guides, right? 90% win rate guide, IFVG versus FVG, high quality setups, stop loss placement guide if you want more elaborate examples and explanations. All of these guides are absolutely free, right? Just join the WAP, get access to them, and study more. But this has been episode 7. I hope you enjoyed. Episode 8 will be coming soon. That will be all about profit taking, right? So focusing here on risk first, and next episode all about, you know, securing those profits, when and where to get out. I appreciate you guys. Until then, bye-bye.